Good morning, everyone. My name is Michael Naidrich, and I am the co-CEO of AmeriVet Securities. As always, I'm joined by my partner, all things rates, Fed and liquidity, CFA Greg Faranello. Hey, Greg. Good morning. How are you, sir?
Good morning, Michael.
I'm very excited today. We have a very special guest. Today we have with us Brian Jones, the chief economist from FHLB New York. There is a lot going on here. I think everyone thinks there's going to be some cuts here in 2024. I think the question is when. Like I always say when we have great guests, my mom raised a smart enough child to stay out of the way. So, Greg, I'll hand it to you and Brian. Thanks, guys.
All right. Thank you, Mike. Jonesy, it's great to be reunited with you again. It's not a trading floor, but I'm thrilled to have you with us.
Thanks for inviting
me. You're welcome. I look at this year, and to me, we have all these rate cuts priced in, but it's really all about the data, I think. And I know you've been constructive on the economy, and I'd love to start off with just getting your general assessment coming out of 23 into 24, what your broader views on the economy are in the U.S. at this point.
Well, we certainly ended 23 on a much higher note than I think people anticipated. Of course, pretty much everybody was expecting a slowdown in the final 3 months of the year, but the slowdown that we had to 3.3%, it wasn't as large as it had been anticipated. If you think about it, in the third quarter of last year, we essentially grew at triple trend growth. In the final quarter, we grew at double trend growth. So, and we've also got a boatload of momentum headed into the new year. If you look at consumer spending, that December real PCE figure that we got last week, it left the level in December over 2% annualized above the Q4 average. So we've got a lot of momentum. We've got a lot of wind at our back going into the new year, regardless of what happens. And I think the current view that we're going to slow to a 1% pace in the current quarter, I mean, I think that's way too pessimistic. I mean, I put more stock in the guys at the Atlanta and New York Fed tracking estimates. Atlanta's at 3.3 and New York as of Friday is at 2.8. Those guys right now, given the data on hand, they look like they're much closer in the hunt than the rest of these guys.
Yeah, I mean, certainly the economy has performed far better than most people expected. At the same time, we're expecting the Fed to cut rates 5-6 times this year. It seems a little bit conflicting at this point. To me, you look at inflation, you look at employment, the Fed is certainly saying that they feel that they're a little more balanced in terms of how they're looking at the two with inflation coming down. I'd love to get your views on, inflation in general at this point, where we're at, and then employment also. We have a big number on Friday, and the markets are going to be watching this number, I think, very closely, given what we're priced for at this point.
Well, I think the thing is the Fed has had a tremendous amount of success in reining in inflation. I mean, we're not at the 2% target yet, but we're certainly well on our way there. And to be fair, even last year, the inflation performance was more benign than the Fed had anticipated over the course of the calendar year. To be fair to the Fed, they originally thought that the inflation flare-up was largely transitory. And it kind of was. A lot of the stuff that we had there was because of, supply chain issues, the pandemic and whatnot. The real problem that you have with the inflation numbers is that we've got this real problem with the housing, the shelter component. It's a major component of the overall CPI, major component of the core, and it's really sticky. And part of the reason why it's sticky is just the sampling that's involved. The BLS only looks at 1/6 of their sample in each monthly report. So you've got this lagged effect there, and there's very little that the Fed can do about reining in shelter costs. I mean, the only thing I joke with people about is if you want the Fed to bring down shelter costs, you should take the armies of economists that they have at the board and at various banks, strap on tool belts with them, and send them out on the road to help complete some of these housing units that are under construction, which are at record levels. So there's very little the Fed can do, I think, about what's keeping inflation higher than it should be right now. As far as the labor market's still white hot. I mean, we've seen that with the jobless claims numbers. They're still, hovering in the high 100 plus, low 200,000 level. The number of people collecting benefits is essentially stabilized. I think we're probably going into a pretty solid report on Friday. I mean, if I had to pencil in a number, I'd go with non-farm payrolls, probably up another 250,000. And I do think, given the performance of the insured rate between survey period, there's the risk that the unemployment rate comes down a tick to 3.6%. I think where you do get something that might be the bond market might like, you're probably looking at a soft earnings number. The survey period for the January report ended on the 13th of the month. And there's this kind of quirk in the data that if the survey period doesn't include the 15th, we tend to get weaker than expected prints. And I think a lot of that has to do with the fact that so many Americans today get paid on the 15th and at the end of the month. But again, even though people are making a big deal about the slowdown in job openings, there are still nationwide 1.4 openings out there per unemployed person. And that doesn't really speak to the tightness in the labor market because most of the people that are still jobless can't fill these positions.
Yeah, it's interesting. You talk about, 250,000 for this Friday. I mean, that's a big number. It's still very, very healthy. And, I think part of the struggle here is, I guess, look, we don't really know when the Fed is going to start to bring rates down, but we know the market is still hungry for all these rate cuts. We head into this meeting on Wednesday, we'll get the statement, the presser, and then, market expectations for all these cuts. What are your thoughts? I mean, how do you reconcile? How should people try and reconcile some of what you're saying, which sounds very, very constructive, versus a Fed bringing rates down 5 or 6 times, 125 basis points, with an economy that still seems to be performing still very, very well? What are your thoughts along those lines?
Well, we're like in the old Sesame Street skit. That one of these things is not like the other. So these things are inconsistent. Something's got to give one way or the other. The problem I think I have with the market pricing of rate cuts is, if you think about it, if you're a central banker, you cut rates to affect a result in the real economy. Okay, you want to achieve something. What would cutting rates do for the real economy right now? The only sector that would benefit is maybe housing. And housing's got other issues. The issues in housing are really more lack of supply generated than they are because of interest rates. You've seen over the last several weeks that with the reductions that we've seen in mortgage interest rates, we have seen a pretty decent pickup in home purchase mortgage applications. We probably see a bigger pickup if there was more stuff out there to look at and buy. I mean, if you think about it nationwide, supplies are so tight that if you are on the median income in the United States, you could probably have afforded just maybe 35% of the homes that were on the market in the fourth quarter of last year. So there's not a lot that the Fed can do about that. And if you think about it, I mean, the Fed raised interest rates by over 5 percentage points, and yet the economy hasn't slowed. If anything, the economy's actually gathered steam. If you think, we've had 6 consecutive quarters of above trend growth. Right now, it looks like we're going into number 7. So, I mean, something has to give here. I mean, the only thing that I would say in defense of the market pricing is, look, if you have some sort of Deus Ex Machina thing that's going to happen, some sort of tragedy that's not on any of our radar screens, it could happen. So, for example, I mean, if you go back to the pandemic, the Fed was really aggressive in reducing rates. And I do think there's a bias. They're much more aggressive in cutting than they are in hiking rates. So, I mean, if there were to be a problem, if, these geopolitical things become a bigger concern, then you could get there. But see, the problem is you've got to, if you're going to have that rate view, I think you've got to tell me why you have that rate view. Because right now we're running well through full employment with an economy where 70% of our activities determined by consumers. The only way you're reining consumer spending is people got to lose jobs. And I just don't see that in the cards right now.
Yeah, no, I think you hit the nail on the head. I think when you throw all that into a blender, people are looking for the why. Why is the Fed going to cut rates here, all things considered? I mean, those outlier scenarios, I mean, they're certainly out there. There are some known risk factors,
Sure.
but they certainly haven't given the Fed enough room to move anytime soon. Mike, jump in here.
Yeah, this is a fascinating conversation because a lot of what Brian's been saying is a lot of what I've been thinking, right? Everyone's been calling for these rate cuts, and it's amazing. You hear it from as early as March to then some people say June, a lot harder for guys like me to follow along than you folks. But I'm sort of that opinion too, that, what is the why? And if things do remain good, what is the Fed accomplishing in cutting rates so quickly? I think maybe in one of our previous recordings, Rick, I asked you, is there any way potentially that the Fed doesn't cut rates at all in 2024? And I still think that's obviously a long shot, but I'm not so sure they're going to cut as many as people think.
No, I would agree with that. And if you think about it, I mean, both the Fed and the markets are data dependent. And if you think about it, several weeks ago, I think the pricing for the March meeting, you had almost fully priced in one cut by March. That's been priced out given the strength of the data. The probabilities of the May meeting have come down. I mean, I think the way you've got to look at the market pricing is it's a snapshot in time. This is what people think, given all the information that we have in hand right now. But this thing can change rapidly if the data doesn't pan out. And I was looking at, for example, the Citigroup Economic Surprise Index. Over the last several days, it's picked up again. I mean, we did have a low in the fourth quarter of last year. Now we're moving higher. The economic surprises are going in a positive direction. I mean, the Fed raises or cuts rates because they want to affect the result in the economy. And I agree with you guys that I don't see what cutting rates would do right now. Who would you help?
I have, I guess, maybe one last question as we come up against time here. And, I always like to point this out. I'm massively politically independent. Where does the election come into this, the timing of rate cuts? I know it's an independent organization or believed to be an independent organization, but does that have any play here at all?
Well, I mean, there's going to be a tremendous amount of uncertainty associated with the election, but no, that's one area where I do have faith in the Fed. They are independent and they'll do what's right for the economy. I mean, even if you fear about it, we always make these distinctions between hawks and doves at the Fed. Okay, the question is when they all sit around the table, they pretty much have similar backgrounds. They've been central bankers for a while, presented with the same information. They're going to make the same decisions. They're going to agree amongst themselves. I mean, the example I always give people from years past was Alan Blinder was always considered a dove, yet he voted for every single tightening. So, I mean, to be fair, I mean, I think it's an artificial distinction. Also, the thing too is no one person is going to sway the whole FOMC. I mean, I'm dating myself here, but you're talking about the days of Preston Martin, Paul Volcker, and we're way past those.
I think that could be a greater, longer conversation, and it's actually encouraging for those who follow it closely, but not as with the level of expertise as you both. To the belief of the independent Fed is great to hear. Greg, I think we're going to have Mr. Jones back, or Jonesy, as you like to refer to him. Maybe I'll need a few more calls with him to refer to him that. But Brian, this has been amazing. Thank you so much, and Greg, obviously, thank you.
No, great. Thanks for having me. And again, anytime you guys want to talk, just let me know, and I'll be back.
This was a riveting conversation. Greg, I'll give you the last word, buddy.
Now, look, I'm going to be looking at the statement with regard to March. Right now, I think that the Fed has a tightening bias in that statement. So if they leave that bias in the statement, they're telling you they're not ready to go in March. If they take that tightening bias out and change the language on Wednesday, I think they're signaling to the market that they could be open-minded about a rate cut in March. But to me, it's less about the first rate cut. It's more about that trajectory. And if you look at SOFR in December of 2025, they've got the funds rate closer to 3%. And I think for markets, that longer-term picture over the next year to 2 years, that trajectory is probably more important than the first rate cut.
Great point. We are definitely over time, but this is well worth it. And I think we'll make sure that we get Brian on for a longer segment here somehow, some way. But thanks again to everyone. Hope all our clients are off to a great start here in January, and look forward to speaking to everyone soon. Thank you both.